Morning, everyone, and thanks for joining our Phillip Securities Research morning call for the 28th of February 2022. So today we've got quite a number of stock market updates as well as Phillip on the ground. So without much further ado, I'll pass my time now to Glenn to start us off with the UOB. Glenn.
Thanks, John. So I'll just start off with UOB. So UOB, our title is Strong Fee Income and Stable Interest Income. So next slide. So for FY21 earnings of 4.08 billion, it missed our estimates by 6% due to lower than expected trading and investment income. The fourth quarter 2021 DPS was stable at 60 cents. So I'll move on to the positives. Firstly, the NII, net interest income, grew 5% quarter on quarter and 11% year on year. This was led by continued loans growth of 2% quarter on quarter and 10% year on year, while the NIM improved 1 basis points this quarter to 1.56%. The full year NII increased 6% year on year, led by healthy loan growth with NIM remaining stable. UOB has guided for mid to high single digit loan growth for 2022. Secondly, the fee and commission income grew 13% year on year, particularly from wealth and loan related fees as investment and trade activities pick up. Fees, however, were stable quarter on quarter as higher loan related and credit card fees were moderated by seasonally softer wealth fees. The full year fee income grew 21% year on year to a record 2.41 billion, driven by double-digit growth in most activities. UOB has guided for double-digit growth in NII for FY22. Thirdly, there was a GP write-back of 76 million, which resulted in full-year GPs reducing by 90% year-on-year to 95 million. The total allowances were at 94 million in the fourth quarter versus 153 million in the third quarter. Credit costs on allowances dropped by 8 basis points quarter on quarter to 12 basis points. Full-year credit costs were lower by 37 basis points at 20 basis points, as 2022 included preemptive allowance for non-impaired loans. The total general allowance for loans were prudently maintained at 1% of performing loans. UOB has guided for credit costs of 20 to 25 basis points for 2022 due to lower SPs. Moving on to the negatives, the loans under moratorium remain unchanged, and we believe that these belong to weaker corporates which still require loan relief. So as the moratoriums begin to expire, we could see an uptick in NPLs in 2022. Management has mentioned that the loan moratoriums in Singapore have reduced to a negligible amount, with the highest amount in Malaysia, as the Malaysian government had extended the relief period until early 2022. Secondly, there was new NPA formation, and it increased by 167% quarter on quarter to 670 million, mainly from several secured corporate accounts, though no concentration risk was observed. Management has mentioned that they are confident that the NPAs will be recovered, as more than half are in Singapore and belong to one particular asset, with the LTV below 50%. The NPL ratio increased 0.1% quarter on quarter to 1.6%. For the outlook, UOB's profit should continue to grow in 2022 on the back of stabilizing margins, stronger fees, and lower provisions. We expect the NII to expand 14% year on year. We continue to expect credit costs to come in below the guidance of 20 to 25 basis points. There is earnings upside from write-backs of the 1 billion in management overlay of the general provisions. Management has also mentioned that as it is being conservative, the intention is only to write back some, but not all of the GPs during the second half of 2022. Full-year NPA coverage is at 96% and unsecured NPA coverage at 239%. So comparing with DBS's NPA coverage of 116% and unsecured NPA coverage of 214% for the same period. Secondly, management expects improvement in NIMs only in the later part of 2022. UOB has mentioned that a 25 basis points rise in interest rates could raise the NII by 150 million to 200 million, or a NIM sensitivity of 4 basis points for every 25 basis points rate hike. So we are assuming that the rate hikes totaling 100 basis points this year, our 2022 NII can climb 800 million or 11%, resulting in an increase in our PATMI by 17%. Lastly, Asset quality is expected to stabilize, and management expects to continue to see strong demand for loans as cross-border activities pick up. The ASEAN loans growth is expected to be higher with some slowdown in Singapore and North Asia. Growth so far has been skewed towards the developed markets as the ASEAN economy remains muted. But management expects this to change in 2022 as the economy recovers. UOB has guided for mid to high single-digit loan growth for 2022. As such, we maintain and accumulate with a higher target price of $35.70. Now, moving on to OCBC. OCBC, our title is higher than expected allowances. I guess. Okay, so for 2021 earnings of 4.86 billion, it met our estimates despite higher than expected allowances, which were offset by higher net interest income. The fourth quarter DPS rose 12% to 28 cents. Moving on to the positives. So the first positive is that the fee and commission income grew 2% year-on-year, but fell 7% quarter-on-quarter due to year-end seasonality. Full-year fee income grew 12% year-on-year to a record 2.25 billion from broad-based fee growth on the back of higher transaction volumes and customer activities, particularly from the wealth management income, which made up 37% of the group's income in 2021. The group's FY21 assets under management rose 7% year-on-year to a record high of 258 billion. The insurance income grew 63% to 1.14 billion, driven by favorable market conditions and higher operating profit from Great Eastern's Holdings insurance business. Secondly, their NII grew 4% year-on-year and 2% quarter-on-quarter, led by loan growth of 8% year-on-year and 2% quarter-on-quarter, while NIMs remained flat at 1.52%. Loan growth was broad-based across both corporate and consumer segments, with the majority of the increase coming from Singapore, Greater China, and the group's international network. OCBC has guided for mid to high single-digit loan growth for 2022. For the negatives, firstly, SPs of 387 million were made during the quarter, and this is 109% higher than the third quarter's SPs of 185 million. This increase was mainly driven by project financing delays due to supply chain disruption brought about by COVID-19. Management said that they are located mainly in Greater China and do not pose a systemic risk. However, OCBC was able to write back GPs of 70 million during the quarter, mainly due to the downgrade of accounts to the ECL Stage 3 allowances, as well as the refresh of their macroeconomic variables in the model. The total NPAs rose by 2% Q-on-Q and 8% year-on-year to 4.3 billion, but the group NPL ratio was stable at 1.5%. OCBC has guided for credit costs of 20 to 25 basis points for 2022, compared with FY21's credit cost of 29 basis points. Secondly, the NPLs in Malaysia were up 8% Q-on-Q to 1.47 billion, while the NPLs in Indonesia were up 17.5% Q-on-Q to 1.21 billion. And this increase was mainly due to loan moratorium extensions in both countries and the introduction of the relief package in Malaysia, where some loans under support were classified as NPLs. Nonetheless, management said that the increased NPLs in two countries are customer-related and cover a broad spectrum of loans and are not trend-related. Now for the outlook. For loan growth, loans grew 8% year-on-year in fourth quarter to 290 billion. This is meeting the bank's guidance of a high single-digit increase for 2021. The management sees further lending opportunities in the wholesale segment and sustainable financing. The green and sustainable finance was up 66% year-on-year to 23.3 billion and now form 8% of its loan book. Mortgage pipelines in Singapore and Hong Kong are also healthy, with more drawdowns expected in 2022. For China, OCBC's total exposure to China remains at 11% of the group's loans, with onshore exposure at 7 billion and offshore exposure at 25 billion. And most of these customers include top state-owned enterprises, large local corporates, as well as their network customers. And less than less than one third of the group's mainland China onshore exposure are corporate real estate loans. The NPL ratio for the non-bank mainland China loans increased to 0.8% from 0.5%, and this was mainly due to the project financing delays. Thirdly, the management has guided for stable NIMs of 1.5 to 1.55% for 2022. Nonetheless, it said that based on historical data, a 100 basis points increase in rates would lead to an 18 basis points increase in NIMs. So assuming rate hikes totaling 100 basis points this year, based on our calculations, our FY22 NII can climb 725 million or 11%, resulting in an increase in our 2022 PATMI by 10%. So we maintain a buy with an unchanged target price of $14.22. The catalysts for OCBC include lower provisions and higher interest income as the economic conditions improve. OCBC is also our preferred pick amongst the three banks due to attractive valuations, an upside in dividend from the 15% CET1 buffer, and lower provisioning as the Indonesia and Malaysian economies recover. So that's all I have for the banks. I'll now hand over to Natalie.
Hi, thank you, Glenn. Good morning, everyone. I'll be talking about Lendlease acquisition of the remaining stake in GEM. Next slide, please. Okay, so sometime on 14th of February, that was when Lendlease announced their acquisition of the remaining 68% stake in GEM. Sorry, hold on for a while. Okay, sorry about that. There was an ambulance driving by. So I'll start over. Okay, so on the 14th of February, that was when Lendlease announced the acquisition of their remaining 68% stake in GEM. So this will bring their shareholding in GEM to 100%, allowing them to attain tax transparency on earnings from GEM. That means that the earnings from GEM will no longer be subjected to a 17% corporate tax. Okay, so this acquisition will double the deposited property for Lendlease, and it will double the deposited property to $3.6 billion. And also it will double its market capitalization to about 2 billion Singapore dollars. Okay, and this will help with increasing its visibility and investor relevance. In terms of office to retail breakdown, so the office comprises 65% of NLA, while this is the other way around. The retail comprises 65% of NLA, while office comprises the remaining 35%. Okay, so this acquisition is marginally DPU accretive at 0.1%, and this is less accretive compared to earlier acquisition of the earlier stakes because of the large quantum which necessitated equity fundraising, and equity fundraising also carries a higher cost of capital. Hence, that's why this tranche of acquisition was less accretive. However, this asset is a very high quality asset. Occupancy at time of announcement was 100%, and occupancy remained above 98% throughout the pandemic. GEM experienced strong retail demand from its dominant positioning in the Jurong East catchment. And for the office component, it is fully leased to the Ministry of National Development on a 30-year lease ending in 2045. So that just means that there's still about another 22 years of this lease left. And this lease is also subject to rent reviews every 5 years. In terms of outlook, post-acquisition, GEM will account for 58% of NPI based on the full year contribution. And the remaining pipeline assets for Lendlease include Paya Lebar Quarters and Parkway Parade. So overall, because the acquisition is marginally accretive, there is no change in our target price of 94 cents. And the current share price actually implies a DPU yield of 6% and 6.5% for FY22 and 23. Yep. Okay, so that's all for me. I'll now pass the time on to Terence.
Yeah, thanks, Natalie. First sponsor reported their second half 21 results. In our next slide, second half 21 revenue grew about 3 times year on year, driven by property development and property financing as the group made good progress with the handover of 6 fully sold residential apartment blocks of the Pinnacle project in Dongguan. in December 2021. So if you look at this table here on your left-hand side, you can see we broke down the three segments of revenue for first sponsor. You can see property development, property holding, and property financing. You can see a surge in the revenue for second half 2021 because of the handover of the 6 out of the 8 fully sold residential apartment blocks of the Pinnacle project. In terms of the positive second half 21 profit of $61.8 million was above our estimates at 53.6%. The beat came from property development. The PRC property financing loan book also hit a high of renminbi 2.7 billion in 2021. The second positive is the revenue from hotel operations also showed nascent recovery. European hotel operations increased 33% year-on-year in the second half of 2021. RevPAR and ADR also showed improvements in the second half of 2021. Management also guided that in the first month of January, they actually saw hotel operations in Europe continue to improve. So that's a positive for the year. Last but not least, revenue from property financing was also lifted by a strong PRC loan book. In our next slide, in terms of the negatives for first sponsor, the outlook for property financing continues to disappoint. Recent policy changes in China put a drag on its loan book. This after the PBOC, the People's Bank of China, boosted liquidity in markets by lowering rates and boosting liquidity in the market. This will have a drag on their loan book, and we expect almost a 50% drop in their loan book for FY22. The second negative is that the Dongguan property market has slowed. The inventory rose to 12.5 months from 3.2 months as curbs on debt and strict COVID-19 measures weigh on the property demand in China. In terms of the outlook, the weak economic outlook in China will continue to cloud the group's outlook. But the strong balance sheet that first sponsor will have from the repayment of their property financing loans will help to allow it to capitalize on new opportunities. So they are currently exploring some deals in the Greater Bay Area. In light of the above, we downgrade first sponsor from accumulate to neutral due to the slower economic growth in China, with a reduced sum of the parts target price of $1.39 from $1.56 previously. So that's all from me. I'll hand over the time to Vivian.
Thanks, Terence, and good morning, everyone. So I will first be doing a brief summary on the upcoming IPO by Oiltek Holdings, which is a spin-off from Cole Brothers Eco Engineering, KBEE, that is owned by the Cole Brothers Group. And following the listing, KBEE is expected to retain 67.4% interest in Oiltek. So as can be seen on the slide, they are offering a total of 22.5 million shares, which is about 15% of the enlarged share capital of 143 million shares. And based on that and the invitation price of 23 cents per offering share, then we would be looking at a market cap of about 33 million Sing dollars. So out of the net proceeds of 3.6 million, 72.5% would be allocated to expanding Oiltek's business operations through securing more projects and also projects of larger scale. And the rest will go towards business expansion through investments, M&A, joint ventures, etc. The public offer would be closing tomorrow at 12 noon and would be commencing trading on a ready basis on Thursday, 3rd March at 9 a.m. So for the dividend policy, they intend to recommend not less than 40% of the net profit attributable to shareholders. And lastly, valuations-wise, PE post-invitation would be at 8.3 times. So moving on to the next slide. This is a quick summary of Oiltek Holdings' 3 main segments. So firstly, you have the edible and non-edible oil refinery. So they do the EPCC, which stands for Engineering, Procurement, Designing, Construction, and Commissioning of this edible and non-edible oil refining plants. Edible products include your margarine and specialty fats, and non-edible ones include those used in sunblock and moisturizers. So the second segment in the middle, which is growing rapidly, would be the renewable energy segment, where they do the EPCC of multi-feedstock biodiesel or maybe in more layman terms would be converting from waste to energy. And for example, converting from sludge to biogas, which can be further converted into steam to power turbines to generate electricity. And the fact that they own the IP, the intellectual property rights to all these technologies, serves as a resilient source of revenue. So the last segment is product sales and trading, where they sell and distribute engineering components, and they also do trading of specialty chemical products. So moving on to the next slide. So yeah, the three main business segments that they have, with the edible and non-edible oil refinery making up about 63% to the first half 21 revenue. Order book is currently at its historical high of about 173 million ringgit, and this is equivalent to about 55 million Sing dollars. So a few key highlights or investment merits. So this is published in the offer document. They offer a diversified and comprehensive range of solutions, being one of the few integrated EPCC companies to provide this whole range of downstream processes. And secondly, they are a process technology innovator with the in-house patented technologies. So currently they have 4 proprietary patents and there are 6 pending patent applications. Other than that, they also constantly introduce new features in their refining plants. An example would be extracting these phytonutrients from crude palm oil via downstream refining process. Thirdly, would be that the renewable energy segment is seeing high growth due to trends like stricter emission standards for combustion engines and also increasing environmental regulation. So to summarize, so firstly, from the edible and non-edible refinery would be resilient growth. And for renewable energy would be developing more types of technologies. And they also see rapid growth with the fact that for renewable energy, the revenue in first half 21, the increase actually mainly came from this segment. Yeah, and the last one would be recurrent source of revenue from product sales and trading. So in our next slide, this would be a quick snapshot of their financial results. Next slide, please. Yeah, thank you. For the past 3 financial years, so you can see on the revenue, it's modest growth, but for net profit line, it almost tripled in the past 3 years. Yep, so that's all for Oiltek. Next, I'll be covering a Phillip on the ground for Aztech's FY21 results. And we do not have coverage on the counter. So for Aztech, their largest segment, which is the IoT and data communication products, this makes up about 95% of the revenue. So you can see that it saw revenue growth of almost 40%, as can be seen from the chart on the right. So the higher revenue came from this higher demand for IoT devices like lifestyle, consumer electronics, consumer health tech, and also smart lighting products, as you can see from the picture on the bottom right. On the second half 21 results, so the revenue and PATMI both increased marginally, higher by about 5%, with the PATMI margins unchanged. On the geographical segments, North America and Europe continued to contribute to the bulk of the revenue at about 96%. Moving on to the outlook, so Aztech's order book now stands at 762 million Sing dollars, and this includes the new orders of 266 million secured so far in 2022. And this 762 compares to FY21 revenue of 624.4 million dollars. So that's about a 20% increase. And lead times are still at 9 to 12 months, but this is on the condition that they are able to secure their raw materials. So with regards to the IoT business, Aztech aims to add 2 to 3 new customers per year and derive 10% of the revenue from new customers. And apart from that, they are also looking to expanding into various sectors like health tech, automotive, and lifestyle electronic devices. Lastly, for Aztech, relating to one of the customers in Germany undergoing this preliminary judicial proceeding, as mentioned in the announcement, the management also mentioned that they stand as a secured creditor, which means that they do not expect any losses from this issue. So that's all for Aztech. I'll now be moving on to Nanofilm's FY21 results, or second half 21. So this again is a Phillip on the ground, and we do not have coverage on them. So for Nanofilm, they have three main segments, as can be seen from the chart on the top right. So firstly, under Advanced Materials BU, AMBU, under which they provide vacuum coating solutions through physical and chemical vapor deposition. So they deposit these advanced materials on key components and parts. And maybe a very basic example would be the Microsoft logo that they coat onto that is coated onto your Microsoft tablets. And also not forgetting, of course, for their largest customer Z. So they do this for your 3Cs products and also automotive segments. And this segment alone makes up bulk of the revenue at about 80%. Secondly would be the Industrial Equipment BU or IEBU, where they design and develop customized coating equipment, not only for their own AMBU and also for selected customers. And lastly would be Nano Fabrication, under which they manufacture nano products in optical lens and also sensory components. So for second half 21, referring to the table at the bottom right, we saw modest revenue growth of about 6%. And this was actually supported mostly by, or actually everything by the growth in revenue from IEBU, and actually also partially offset by the nano fabrication drop. And on a full year basis, revenue grew 13% and PATMI was up 8%. So it was mentioned that the margins actually fell in the first half of FY21 due to higher expenses incurred for the Shanghai Plant 2, with build-up area almost twice that of the current Plant 1. So with Shanghai Plant 2, then this would mean their capacity being able to almost triple. For the outlook, so firstly covering AMBU. So AMBU, the sector was impacted by supply chain disruptions, and the growth of 6% on a full year basis was supported by the 3Cs and also automotive segments. And with the expected easing of supply chain disruptions, then they are expecting a much stronger growth in FY22. Secondly, for IEBU, so the growth is due to higher demand by sustained recovery in the customer's capex cycle. And moving on, Nanofilm would be developing new equipment designs and also solutions to further penetrate the renewable energy industry. Lastly, for nanofabrication, it saw lower revenue due to an end-of-life project in first half 21. But moving forward with the first micro lens array MLA project for new generation wearables entering mass production in the fourth quarter of FY21, this would be the additional and next revenue driver for Nanofilm. Yep, so that's all for Nanofilm. The last counter for me would be a Phillip on the ground for AEM Holdings. So moving on to the next slide. So when we look at AEM, it will be mainly talking about system level testing or SLT, which refers to the ability to test a chip or multiple chips in a package to simulate the final user environment in order to test the software. Basically, it means that making sure that your chip is be able to work for its intended use. And handler machines are designed for the testing functionality of the semiconductor components. So you can refer to the pictures at the top for the products that they produce. So you have the handlers, consumables, and also testers. Results-wise, for 4Q21, revenue and PATMI both recorded very strong growth, but on a full year basis, there was only modest growth for PATMI and modest growth for revenue, and PATMI declined by 6% year on year. So they mentioned lower PATMI due to the key customer preparing to phase over to next generation testing platforms, and also higher R&D expenses. The top three geographies where they derive manufacturing revenue are Malaysia, Costa Rica, and Vietnam. So for the outlook, revenue guidance for FY22 was 670 to 720 million Sing dollars, with about 10 million capex planned. Taking the midpoint of this revenue guidance, if we compare to FY21 revenue of 565 million, then that would be a 22% increase. So with the capex plan. This also shows their plan to continuously invest in R&D, and it was also mentioned of their that they hope to maintain overall margins. Further plans include, so they announced in August last year that they would be the system level testing SLT provider to this major memory integrated device manufacturer, or IDM for short. And they are also ramping up on the volume for the next generation kind of SLT. So a bit more on the technologies that they provide. So if you refer to the chart on the bottom right, this is their modular parallel smart offering. So they are able to scale up from lab development, testing a single cell, to being in full production mode. You have 10 tester columns with 60 cells in total. So this is part of the strategy of test cell automation. And referring to their key customer, they have announced a very aggressive technology roadmap. In the news includes investing 7 billion to build a new chip packaging and testing factory in Malaysia. And about a month back, another announcement regarding investing 20 billion to build a plant in Ohio for more chip production. So all these front-end investments would benefit AEM a few years down the road. So with more testing abilities required and chips becoming more complex, more packaging kind of requirements, AEM is also ramping up their current and new platforms to take care of these new technologies and cater to evolving customer requirements. Yep, so that's all for AEM. I'll now be passing the time on to Paul to Timothy for SOG.
Yeah, thanks, Vivian. Just a short one on Singapore ONG, Phillip on the ground. We don't cover this company. So they are obstetrics and gynecology. They focus on delivering babies and taking care of babies after they're born, and also cancer-related and dermatology surgeries. So they own 17 clinics and 17 specialists in Singapore. So they just reported their FY 2021 results and gave some color on how the healthcare sector is doing. Right now, they are seeing some wage pressures. So first of all, the revenue was up 6%, but the PATMI was down 12%, mainly due to remuneration, which gained 10% year on year. So what impacted this was that there was no more government wage support, and they had to pay off higher incentive bonuses to their staff to help to try to retain them. And also they expanded 2 new clinics. So some highlights from their results. The Singapore birth rate is down 2.2% in the year to about 38,000, and this is the lowest in 5 years. It's been declining consistently every year. So for them, the deliveries was down 12%. But overall, in their ONG, obstetrics and gynecology segment, the revenue was down only 8%. So giving birth deliveries is in the obstetrics, but the gynecology helped to offset this decline, which this gynecology services gained 22%. So they served 366 patients in the year. And this is also a higher margin segment. So I guess more women are looking for more care for their reproductive system, despite having lower deliveries. So the revenue was down, so it was pretty resilient for their core business, which is the green bars on the right. For the cancer related, it dropped 54% year on year. This is because one of their breast cancer surgeons left. So they have recruited a new one, but it's still in gestation period. So this is, I guess, highlights the risk of how much they rely on the doctors. With regards to passing on the higher cost to patients, they are able to pass over the higher supply cost from medical supplies, so the medicine and all that. But they only raise surgical prices when the cost cannot be contained. So they want to keep prices reasonable there, and they're not raising prices. So they're not really passing on the costs over to patients yet. With regards to the recovery, the vaccinated travel lane recovery is still minor. So it's still they're still seeing a small percentage of medical tourists coming back. And it's still at a small percentage of pre-pandemic levels. And this is also affecting the cancer-related services, which is the pink bars on the right. So So the last update is with regards to senior doctors, and which is also why they had to pay higher incentive bonus recently. Recently, the senior doctors renewed their contracts. So now they have an average of additional 5 years of contracts with Singapore OMG. So they experience a higher incentive bonus now, but they do not expect any drastic wage increases moving forwards because the incentive bonuses are only revised upon the contract renewals. So with regards to this business, it showed some headwinds last year, but moving forward with recovery will largely depend mostly on the recovery of the VTLs from what we see. So I'll pass the time over to Paul.
Thanks, Timothy. Just as a reminder, Phillip on the ground is basically to update everyone here for some of the briefings that we attend. I mean, not the small group ones, but those briefings that is out there for the analysts, because we understand some of the attendees here may not have time or maybe do not have access to some of these meetings. So that's why we do this Phillip on the ground, just to give you some of the highlights of the presentation done by the company and hopefully can help you, in your investment decisions. Because I saw a question, what's the difference? Whereas when we do coverage, we have models, we have recommendation. I mean, that's the main difference. But anyway, sorry to sideway that, but just to go through on Raffles Medical second half results. So our title basically that there's a downtime ahead. So in terms of the results, it was above our expectations. The main reasons the results did better was again due to COVID-19 related services. As you can see from the table on the left, the issue we have is that they do not tell you how much it contributes. But if you look at Parkway or RHH results, you're looking at probably around 20% of their revenue comes from COVID-19 related vaccinations and swab testing. So in terms of the positives, it was again pandemic drove growth, although we had the lockdowns. And another driver was China. So they've opened Raffles Shanghai mid of last year and Chongqing the year before. So this starting to provide some revenue growth, albeit it's still very small. It's only like 7% of revenue. The other positive was just as usual when the earnings was up, so they generated a lot of free cash flow, almost 100 million compared to the year before. The negative was basically the staff costs. It jumped 32% year on year. Although revenues was only up 16% if you look at the table on the left. So I mean, what is happening is that there's of course a shortage of workers, and also they also highlighted that a lot of the healthcare workers are they are under very stressful conditions. So most of them actually might have kind of left the industry too. So that's another contributing factor to the shortages and the need to also raise wages. But anyway, the more important will be the outlook. So we think FY22 will be weaker for Raffles Medical. The first reason will be the lack of COVID-19 related services will decline. There'll be less PCR swab testing, and also there'll be less vaccination programs. So, but what they still do is they actually run some of the medical, some of the COVID-19 related facilities like those you see in Expo. But the second reason why it will be weak is that the recovery in foreign patient volumes, although the borders may completely reopen, will be slower than expected. There are two reasons for this. First reason is that the foreign patients, they mentioned they're kind of diverting to your neighborhood countries, neighboring countries, sorry, like Malaysia and Thailand. So that's the first reason, where the prices are more competitive. The second reason is also foreign patients have become more accustomed to their local healthcare facilities. I mean, after 2 years and if you of pandemic and shutdowns, some of these foreign patients that typically come to Singapore may have also diverted to their local healthcare. And that's also another reason why you may not get back the volumes that you did pre-pandemic. The third reason will be the losses in China. So they don't really give the exact number, but the general guidance is that for a new hospital, you usually lose 10 million EBITDA first year, then maybe second year it drops to maybe 5 to 8. But remember, this is EBITDA, so at net profit level, the losses will be even larger. So what's happening is that because although Shanghai only opened in July, but it was really very small scale with minimal staff and also equipment. So when you get the full year operations in Shanghai, so that would be another drag to earnings. So we think our estimate, or you can call it guesstimate, is that maybe the losses will be around 18 million EBITDA for next year. So that will widen even more. Yeah, so these are three reasons why we have weakness, and that's why we kind of downgraded our recommendation. I mean, we maintain neutral, but we kind of lowered our target price. Next slide. Move on to Propnex. Next slide. So for Propnex, the results was of course fabulous. If you look at the table on the left, you know, the earnings basically doubled to 14 million. It was a bit lower than our forecast, about 5. So the positives was, you know, the operating leverage. There was a surge in revenue of 56, but the earnings, you know, almost doubled. You know, because when you take on more transactions, you don't need to raise the headcount. The next was also the jump in cash flows. It's also again the reflection of their asset-light and highly cash-generative business model. So they generated almost 80 million of cash last year, and now their net cash in the balance sheet is 146. So even though they paid a huge dividend this year, that's only about 46 million. So if they want to, they can still continue paying about. But we think the dividend will probably drop to 9 cents this year, or a dividend yield of 5%. So in terms of the outlook, I think I'll go more details later, but we think we expect transactions to have a sharp decline. And as a result, we downgrade to neutral, lower target price, and we cut our PATMI by almost 27%. This will be a year of consolidation for them, because what typically happens, in the top bullet point again, if you look at the last round of cooling measures, the last 2 cooling measures in 2013 and 2018, the combined new and resale volume only recovered to a new level after a 2 to 3 year period. So obviously this year will be weak, and then you could see probably some recovery in the following year. Next slide. So let me just share, I guess the outlook more important. I think we all know that they did well. So in terms of the outlook, the table on the left is their guidance and also APAC Realty's guidance. Most of the guidance, you can see the small little italics, is that these are all unique guidance, but I'm just giving you the percentage. So new home sales will bear the brunt. I think they're looking at 20 to 30%. Of course, that is our assumption of what it's worth. Then for resale, it will also decline, but at a smaller extent. Volume transactions for HDB, APAC a bit more bearish, but they're either flat, but for us, we think it could actually grow. But anyway, okay, let me just run through some of the commentary by all these agencies on the outlook. And so in terms of new home sales, it will decline. Number one is also because there's a lack of inventory. So the inventory, especially in OCR, where most of the mass market volumes are, is only 4,000. So it's like, I'm not sure, it's probably like a record low. The other thing is also the lowering of TDSR on the cooling measure, we think could also be impactful. We'll discuss later. Resale should decline less because the price points for resale are less, so the volume should not drop so much, I guess. HDB will still be resilient because of the BTO delay, attractive grants, and household formation and so forth. An important driver for Propnex this year will be market share gains. So they've since 2019, which is pre-pandemic, so their number of agents are up 15%. So there's a good chance that they can at least get trip up their market share to kind of at least sustain some of this, to contain some of this decline in transaction volumes. The last part is, just for, I guess, everyone's interest, if you want to know what are their views on property prices. So for Propnex, they think private residential will still climb 3 to 5, APAC 1 to 3. HDB prices, they think will climb up even higher, 6 to 8, and APAC, I think you can see from there, 4 to 8. So the demand is still intact, I think, for us on the bullet points on the left. So we think that, because in general, there's still household formation of about 21,000. So you could kind of assume there's demand for 21,000 housing. In general, some of these could be remarriage, but not to go so detailed, but in 2020, there was 21,000 marriage. So you can assume there's demand for 21,000 housing. And because of the BTO delay, a lot of this is shifting to private and HDB resale. Then the other thing is that HDB resale would be vibrant and can provide the catalyst for HDB upgrading is mainly because, number one, there's a lot of units that reach the 5-year minimum occupancy period, around 35,000. And the second thing, and I guess the more important thing, is that based on their calculations, this one is very hard for us to compute because we don't have the data, but based on their calculations, those who sell the HDB after 5 years right now, they probably can get like 200,000 to 300,000 equity or gains, you could say, and this will be what they can use to kind of upgrade themselves to private. Again, these are their estimates. We can't really compute them that accurately as them because we don't have the exact details. Then the third bullet point why demand could still hold is because just a refresh. The cooling measures is hurting, of course, the first time, but doesn't affect the first time home buyers or citizens or PRs. But I think the nuance here is that the lowering of TDSR, just that means only 55%, used to be 60% of your income can be used to pay the home loans. Now they cut it down to 55. But in the recent Parliament Q&A, I mean, the authorities did say that almost 40% of all these private residents that apply for loans would have breached this new rule, whereas only HDB. So this can be a bit of a worry. That means not many could qualify. I mean, if you read it literally, not many can actually qualify. That means 40% would not have been able to qualify for home purchases under this new ruling. But of course, we do not know how much is investment and how much is new homes. But anyway, so sorry just to complicate things. So anyway, in general, it will be a weak year for a year on consolidation. Yeah, sorry, it's a very long slide. Next slide. Okay, in terms of venture, next slide. So the results met our expectations to the dot of virtually was 100% of our PATMI. We saw revenues jump up 9% year on year. In part, there could be some spillover because third quarter, as you recall, a lot of their plants were shut down. So only they resumed some of their Malaysian manufacturing only 1st of September. So there could have been some spillover. In terms of the positive, was of course the recovery in revenue, because our issue for venture was always the ability to grow revenues, which was kind of like a sideline for the last 2-3 years. The negative was the cash flow. Cash flow was down because they had to build up a lot of inventory. So the cash flow was only 91 compared to the 401 million in last year, but a lot of it went into building up the inventory because of the supply disruptions. So in terms of the outlook, firstly, venture guided that it will be a very robust demand. But for us, we think it will be a stronger year. The order pipeline is healthy across all verticals, as what they mentioned. But the issue will be just the component shortages. They explicitly mentioned semiconductors is where the key of the shortages are mainly in semiconductors. You can name the it's like from Texas Instruments, Xilinx, Silterra. So these are all the types of semiconductors that are facing shortages. So it's just the ability to meet the demand. But for us, we think they have a better chance of handling the component shortages. Firstly, because they already bought up almost 1 billion of inventory. So this is a record amount of inventory they have. And also, there's probably a higher readiness compared to the past. So this component issue has already been around for 2 years. So they've been better able to manage and execute better around all these shortages. So some of the things they do, example, maybe they just redesign the machine, or the orders or the customers' products, so that maybe you use less semiconductors. I mean, these are some of the things they do. So that's why we think this year will be a growth year for them. And that's why we kind of upgraded it to accumulate from neutral, and also we raised the target price. And so far, historically, they never really mentioned the word robust. Because most of us, when we go for their meetings, no, they don't tell you who are the customers, and they give very macro, very top high level explanations. So we are never able to tell you which customer do well, which customer can't, but they'll just give you a very macro overview. So this year seems to be, FY22 seems to be a better year. Next slide. Okay, these are Sheng Siong results. Next slide. Okay, so the results actually beat our estimates, and if you take out the government grants, the profit would actually have jumped 41%. So the main highlight of the results was that the positives was that the gross margins continued to climb. I mean, I'm not sure this is a record level, so it's like how many quarters of improving gross margins. So gross margins can only improve when they have a higher fresh food. So fresh food is mainly your meat, poultry, and fish, and what's so forth. So that continues to grow. We think it from maybe low 40% of sales to right now, to mid to high 40% of sales. So the higher contribution from fresh food is helping their margins. Some of the reasons is probably the customers are beginning to become more aware of the quality and competitiveness, and they are taking market share from wet markets. The other part that's doing well for them is the house brands, and they expand with almost 100 SKUs. That means 100 more variations of frozen food. Most of it in frozen food, obviously. I think probably that's where the best margins are. So these are some of the drivers. The other positive is that they are expanding new stores. Just to refresh, I think we had an issue with them because they've not been able to open any new stores for almost, I think, 2 years. Because of all these BTO delays, because most of their new stores are in HDB. So, almost 5 quarters. Okay, so 1.5 years, sorry. So right now they've already got 3 stores secured, totaling 19,000. So this could grow their footprint by 4%. What it means is that it can also grow their revenue by 4 percentage points. And so this is the positive part for new store sales. In terms of negatives, there really nothing. I mean, the earnings was kind of above our expectations, so hard to say anything negative. In terms of outlook, okay, the issue now for Sheng Siong would be how this year's sales will trend, because it's not that it won't be that clear, because what has happened is once the borders reopen and then dining restrictions lift and more people return to office, it will be less clear as how much dining will be done by households at home. So that will be the uncertainty. But for us, we really forecasted a drop and so forth. And also we think that gross margins will still expand because fresh products will continue to creep up as they take market share. We still maintain our buy. We kind of nudge lower our PE valuation because of this uncertainty, but usually they trade about 23 to 25 times PE. So that's how we got our target price. So, but 2022 will be a bit of a transition year because it all depends how much people eat more at home. I mean, in a nutshell. Yeah. Okay, thanks. Next slide. Okay, I'll just go through our weekly. Not much detail. Everybody just watching Ukraine on TV, so not much macro to discuss. But the main thing would be for Singapore, will be our inflation numbers came up. So the core CPI was actually quite. I think it's probably higher than expected because it's at 2.4, and the MAS is looking at 2 to 3%. But we already started the year already in the middle of the range. So probably very high possibility the MAS might have to raise their projection and probably maybe steepen the Sing dollar curve a bit because inflation is rising faster than expected. And one way they can control it, maybe a stronger Sing dollar to probably reduce imported inflation. The other big number is the US. Again, inflation is also very high there. It's the highest since 1983. So in terms of tactical views, you can just think of this as guesswork because this is very fluid, and it's like trying to read what is Putin's next move, which we obviously don't know. But let me just tell you what are the key points that we can say for what it's worth. So one good thing is that the tail risk is removed because so long as the US and NATO don't get involved in the war, then at least the worst case scenario is off the table for now until recently what Putin just mentioned on the nuclear weapons. But anyway, so for this, there's no deflationary shock. We don't think global economies will swing downwards because of this event, but there will be an inflationary shock because no real incomes will squeeze and so forth. So it might impact discretionary spending. The issue right now will be what are the central banks posturing? So important that the Fed don't sound a bit more hawkish or anything else, then they will kind of scare the market that we are facing this uncertainty and the banks and the central banks want to tighten. So that's probably a very important point. In terms of the timeline, your guess is as good as mine, but I think the view out there is that Russia don't put 200,000 troops there to do negotiations. They're there to overthrow a government, otherwise you won't put 200,000 troops. Again, this is commentary. I mean, it's not. This is just the general view. In terms of some impact, just for info, I mean, the ruble is down 10%. The Russian stock index is down 35%, and their bonds also got cut. So they are feeling the pain. The worst case scenario is that if Putin were to retaliate and cut all of Europe's gas, GDP, this is not my number. Actually, the European Commission, I think they actually give an exact number what happens to GDP. So the worst case is that if they cut all the gas, Europe will fall into recession. It is their exact number, I think 3 percentage points. I'm not sure how they calculated, but Europe will go into recession once the gas is cut off if they were to retaliate. And of course, we all know the oil price. I know Russia is like 12% of world trade. And if you are interested to know like how much Singapore imports or exports, which I was also curious, but this is just for your info. So from us, we hardly import anything from Ukraine. Russia is 3.2 billion, but that's I think 1 or 2% only of our total imports. I think the rest everyone can see. In terms of the events to monitor, apart from Ukraine, the Powell's testimony will be important on 2nd of March. Because this will be the last time he speaks before the Fed meeting. So hopefully he don't sound too hawkish and kind of freak the market out again. For this week, we have a few events. Friday, some of these are for TRs, but most of them are talking about the whole restructuring or their EGM that they're going to have. So the next one will be on Friday, 12 o'clock by SPH. So if anyone wants to get an update, feel free to register in our Poems website. Next slide. Yeah, I think all this we'll just skip. I mean, the cases are coming down. So, next slide. Next slide. Okay. Sorry, this is one last one from us. Sorry to lengthen this so long, but this will be on Wilmar's briefing. So for Wilmar, if you look at the table on the right, the results was up 4%, the PBT. The headline number looks really strong, about 30%, but it's because they had lower taxes. And if you look at the cleaner number, maybe EBITDA was up about 8% for second half. And they are paying a 15.5 cents dividend. So that's to give you some talking points. One of it was, of course, Ukraine. So Ukraine, they said, will impact REIT. They have a plan in West Ukraine, but it's still running as what they mentioned in the meeting. In terms of the operations, so do note that Wilmar has broadly 3 parts. There's palm oil plantation and refining. Then there's soybean crushing, number 2. And this is the third one is the consumer products. That means they sell edible oil in China, branded edible oil to consumers in China and also in Indonesia. So on their first division, which is soybean crush, that one doesn't look good, the outlook in the near term. What has happened is that South America, they said, supposed to have a lot of beans, supposed to have a very good harvest. It didn't happen. So as a result, the soybean prices went up. But the problem was in China that buys all these beans for feedstock. The prices were down because basically hog and chicken prices are down because there was just oversupply because of the high prices 1-2 years ago. So as a result of this, volumes are down, and they will these producers will either go to lower quality feed. So this impacts Wilmar because Wilmar doesn't really sell the feed. They want the feed so that they can extract the oil. Then the feed will be, mainly they want the oil, not so much for the feed. But because of that, the volumes are down and their customers are not doing well. They won't pay so high a price. So as a result of it, they just kind of said that they shouldn't have good margins because there's not enough volume, and a lot of it is fixed costs. So soybean crushing won't do well. So that's division number 1. Division number 2 also may not do so well because we all know edible oil price, palm oil price are record high, but they are not able to increase their selling price. Number 1, because they do not want to lose market share. Number 2, they do not want to be accused of rising. Mostly these are edible products, and you're selling in Indonesia and China. So it's a bit sensitive. I mean, if you to be seen to raise price too aggressive. And also they mentioned that the Chinese economy is slower, so they're going to eat the same, but maybe they just don't eat so high quality, which is where Wilmar, under their listed Chinese company, they sell the higher priced, more expensive edible oils. The third division, that part will do well because palm oil prices will remain steady. According to them, because the soybean volumes production is down, and also palm oil output isn't rising that much. It's not rising, so that's why they think the supply is very constrained for palm oil, and they should keep prices up. In the longer term, one of their new growth engines is the central kitchen, which they are going to build in very huge scale and also integrate. So basically, if you're a big dining company or restaurant in China, you can just source all your materials from them. Soya sauce, wheat, flour, everything from them. So this is like industrial kitchen that they can supply to all the restaurants across China. So that's their new growth engine for them. Yeah. Okay. I think that's it. I think it's quite a lot. Okay. Thanks everyone. We can go to Q&A.
Okay, maybe I'll take some of the questions first. Okay. Okay, let me see what questions I can take. Okay, so one by James. Seems like OCBC are quite reluctant to formulate a formal dividend policy, even if it's high CET1 ratio. My view on this. Good question. So I think management did mention something about a progressive dividend policy, and they would increase their dividend with growth. So their CET1 optimal level for the CET1 now is they said it's 12.5 to 13.5%. So when questioned, they were quite reluctant to say that they will bring up the dividend, but they did say that they would ratchet up the dividend as they go along. So if they want to bring down their CET1 level to their optimized level, I mean, there's only one way they can do it. Two ways, I mean, they can invest or they can pay dividends. So I mean, there's something to look forward to, that they would maybe have a special dividend or increase their dividends. Okay, second question. What is OCBC's total exposure in mainland China, and what kind of influence will it have on OCBC's performance? So I think I mentioned earlier that their total exposure to China is stable. It's at 11% of their loans, and their onshore exposure is 7 billion, while their offshore exposure is at 25 billion. So most of their customers are top state-owned enterprises, large local corporates, and their network customers. So I mean, as less than one third of their onshore exposure are corporate real estate loans. They are not really affected by any of the Evergrande stuff. And the NPL ratio, however, did increase. They increased by 0.3% to 0.8%. And this is mainly due to the project financing delays, which I mentioned also earlier, which increased their SPs. So let me see what other questions are there. So one by Garo, sorry for pronouncing it wrongly. When will the bank increase the interest rate? That's a very good question. I think this will mainly depend on when the Feds increase their rates, and then Singapore will follow, and then the banks will then follow suit. So I guess we just have to wait and see. Okay, I think I hand over the rest first. I'll answer the rest later.
Yeah, okay, I'll just take the next question. Can you comment on Sembcorp and Sembmarine? So I'll comment on Sembcorp first. Their second half 21 results were above market expectations, and also our expectations. The main reason for the beat for Sembcorp Industries was because of conventional energy. So the conventional energy segment actually received a very, very big boost, especially at the tail end of 2021, November and December 2021, because of the spike in oil prices, which also benefited their overall operations. So when you look at the operations around the world, in the UK, crack spreads and dark spreads also improved, mainly because of the volatility in the oil prices. And in terms of their guidance, forward guidance also, the first month of January this year, also they're also benefiting from the volatile energy prices. Sorry for the background sound. So generally a very good set of results. For Sam Marine, we don't cover Sam Marine, but the current overhang on Sam Marine would be the potential signing of an definitive agreement with Keppel Corp. So this is expected in the first quarter of 2022. So we still have about a month to go. So that will be closely watched to see what kind of arrangement they will reach with Keppel Corp with regards to the merger of their O&M. So until that's released, there's nothing more to say. Yeah. Okay, let's go to see if there's any other questions. I think that's all for now. I'll hand back the time to the rest of my colleagues.
Hello, maybe I will take a few questions. So, firstly, in your hi Vivian, in your opinion, is 23 cents a fair price to pay for the Oiltek IPO share? Maybe answer this part of the question first. So the PE post invitation is expected to be around 8.3 times. Seems quite fair. I mean, if we were to do a comparison to maybe the Cole Brothers Eco Engineering, so they are a subsidiary of this KBEE. It was trading at about 30 times. So I guess it's a much fairer kind of valuation. And also based on its dividend policy, how much dividend in dollars and cents can the investor expect to receive? So I did a quick calculation based on the first half 21 results. In first half 21, according to the offer document, they had a net profit of about 4.35 million ringgit. If you take 40% of that and converting to Sing dollars, then that would be 562,000. And then dividing by the total number of shares, that would be the total share capital, that would translate to about 0.39 Singapore cents. Yeah, sorry for that. And that, according to 23 cents share price, would be an dividend yield of 1.7%. This is on a half-yearly basis. So if we look at full year, then that would be 3.4% for dividend yield. So, but this is just based on my own kind of calculations, based on their dividend policy also. Yeah. Next question is, Nanofilm's PATMI increases but its EPS decreases. Is there a reason for this? Yes, for Nanofilm, the EPS decreased because they issued more shares under the employee share option scheme. So with the higher number of shares, then comparing to second half 2020, earnings per share, the base increased, so the EPS, even though PATMI increased, the EPS decreased. Yeah, so that's the reason for that. And maybe the last one, what was the reason for AEM price sharply dropped from above $5 to current $4.21? Don't really have an answer for this. I guess it's just mainly due to the weak regional market sentiment in so far this year. And is Temasek Holdings one of their major shareholders? Yes. So they did a private share placement in August last year and issued 26.8 million new shares. And that amount issued to Temasek actually represents that Temasek would have 9.5% of the total number of their issued shares. Yep. So I think that's all for me. We'll pass the time back.
Hi, I'll take some questions. So what is your view or outlook on CLI and CDL in view of their recent announcements? So we are still working on the report, but I'll just give you some of the key highlights. So we start off with CLI, CapitaLand Investment Limited. Yeah. Okay, so in terms of their earnings, they actually beat our estimates quite significantly. And in terms of DPS, dividends per share, they also beat our estimates. And I think 15 cents of dividends, 12 cents is ordinary, 3 cents is a special dividend. The reason for this is because they wanted to make up for the lower dividends in the previous year, and also because they managed to divest, and the performance was actually quite good this year. So for CLI, performance was good because of in terms of operationally, one of the key goals after the restructuring would be to grow the fund management business. So overall, they managed to hit their fund management growth target of 10%, largely driven by the acquisition, or rather the growth in AUM from the REITs side. Although they did make a significant headway in terms of their PE funds, where they managed to inset seven new funds and raised about $1.4 billion. Yeah. So overall, I think their funds, the AUM has grown from about 76 or 78 billion to about 86 billion, thereabouts. Yeah, in terms of FAUM, yeah. Sorry, 78 to 86 billion. On top of that, the fund management fees, recurring fees, they actually increased by 34%. So that it was actually 306 million FY20 and increased to 409 million in FY21. Part of it was also due to the event-driven kind of fees, which is due to the acquisition and divestment fees from the buying and selling of assets by the REITs. Yeah. So overall, whether or not this is sustainable, I think the management, in order to achieve the target of 10% growth per annum in funds under management, it would mean that the REITs will also have to grow and continue buying and selling, as well as the PE funds will have to continue to inset more funds. And in that sense, it is partly sustainable. Yeah. Okay. Another part, which is so I think that pretty much sums up the benefits from CLI. Not to mention also, of course, there is they continue to sign more keys under the lodging segment, and also the recovery in the lodging assets. For CDL, okay, so CDL, in terms of their operating segments, the segments that did well, of course, was first of all the development segment, where they managed to achieve a record property sales, 2,185 residential units sold at a record total sales value of about $4.3 billion. So that was a clear positive. Although there has been a little bit of margin compression compared to previous years. Apart from that, also strong rebound in the hotel performance, where EBITDA turned positive. Since the pandemic, it has been trending at negative, so it turned positive. About $111 million in EBITDA for the hotel segment, and this of course compares to about $288 million loss in the previous year. Unfortunately, despite this strong turnaround in the hotel operations, they are still PBT negative, yeah, slightly negative. So in terms of forward-looking, briefly touch about the investment properties. So for investment properties, I think they did worse off year on year, and this is because of less divestment gains, which propped up the earnings for the previous year, and also because one of their malls, Jung Salon, which is in Phuket, is still under redevelopment, and also Phuket still remains relatively close to travels, or rather there hasn't been much of a significant recovery in terms of tourism. Looking forward, next year we will expect to register quite significant divestment gains. First of all, one of it is from the divestment of one of the assets in Seoul, where they will reap about 550 million in divestment gains. Also, the divestment of the Tanglin Shopping Centre, which is currently held in the books at cost, at a very, very low cost, because the asset was purchased many years ago. So there will be the deal hasn't the actual numbers of actual divestment gain has not yet been tabulated, but there is expected to be a significant gain from this divestment. In terms of CDLs, they also actually sorry, the dividends that they proposed is actually total of 31 cents. 12 cents is in cash, and the remaining 19 cents is actually proposed to be distribution in species, which means that they want to distribute CDLHT shares as part of dividends. And what will happen with this is that it will actually result in a deconsolidation of CDLHT. The benefits of this deconsolidation is lower gearing. Also, I guess it will also incentivize the management to actually start to be a better, so-called inverted commas, better sponsor to their REIT by trying to channel more assets to be reinvested or rather to be bought by CDLHT. Yeah, and also because when CDLHT is deconsolidated from their books, any divestments, the gains will actually be more significant or more visible. Yeah, because otherwise CDLHT will still be consolidated under their books. In terms of there are other potential benefits looking forward. One of the assets, City House, which is located in the CBD just opposite Hong Leong building, they actually qualify for CBD CBD scheme where the asset could potentially receive GFA uplift if they were to be repositioned or redeveloped. Yeah, so this asset actually benefits, or it is within the CBD scheme. However, of course, the management is still reevaluating whether or not they want to go ahead and how accretive this redevelopment of City House could be. The listing of the UK commercial REITs was supposed to happen sometime in 2021. We were all anticipating it. However, it didn't happen. The management is still trying to push ahead with this listing of the commercial REIT. And in terms of the only update we had from them was that the occupancies for these UK assets actually has improved. From it is now in the high 90s. Yeah, so if anything, all things considered, listing right now would have been better than listing in 2021, because right now the occupancy has been uplifted, making the assets more stable. Okay. During the year, CDL also acquired three new land sites. One of it was Tengah, and another one was at Bukit Timah. And so these two land sites, I think, they didn't have to bid that aggressively for the land, because they already do have a substantial inventory pipeline. So, and one of the reasons why they didn't bid as aggressively, even though they did win the tender, was because they were trying to protect their margins, in view of the rising land costs as well as construction costs. Yeah. So overall, they managed to replenish the pipeline at manageable land investment costs. Yeah. So I think that pretty much sums up what I have to say about these two counters. More updates to come when I release the results. Okay, I'll pass back to Paul for now.
Okay. Thanks, Natalie. So let me just take one or two questions here. Paul, what is your view on Aztech Global and AEM for 6 to 9 months? For AEM, of course, the outlook is good, but it's a bit concerning that even though they announced such a good guidance, the share price actually still corrects. Yeah, the stock that I thought looked interesting, if you're playing electronics, would be, I think, Valuetronics, because they just announced a share buyback of 90 million, I think 90 million Sing dollar share buyback, and their market cap is 200 million. So basically, they're going to buy back 40% of all their shares. So I thought that would be the best way to play electronics right now, because someone just underwritten all of your downside if you want to buy, right? Yeah. So I thought that was probably the more interesting electronic stocks. For EM, the outlook is good, but just that it seems that the market already priced in a lot of this, and of course, semiconductor index is also down 11%. So that part is just the price action is a bit more worrying. For Aztech, my own view is just that you are basically buying Blink. I mean, that's their main customer, the Amazon Blink. The only issue is that we have no visibility how well Blink is doing. That's number one. Number two is the risk is that Blink may second source. I mean, we're not sure. I mean, we no idea. But if Blink decides to second source, and Aztech is probably 70% of their sales, that could be a risk for Aztech. But in the meantime, I think the outlook will be good for this year. So both companies, the outlook is good, but just worried of these conditions, especially the price action for AEM. But I mean, no denying Intel do so well for going to invest for the next 2 years, so the outlook should be strong. Yeah, I hope that's useful for you. Paul, appreciate your comments on Oiltek. Oiltek, the worry, it's a good company. I think it seems to be they have a very strong niche in building plants for palm oil. But the thing is, do we really want to buy that? Is it, if palm oil price drops, then what's the outlook for this company? So I think if anybody wants to play into palm oil, they probably just buy into a palm oil plantation stock. Because the issue is that if palm oil price drop, will the palm oil companies raise capex? Yeah, it's probably unlikely. So that could hurt them. The caveat is that unless you have an insight on the capex cycle, because this company builds equipment for palm oil companies, so you must have a deep understanding of what is their capex plan. So unless we know that even though palm oil price drop, the capex continues to grow, right, or expand, then maybe it's worth considering. But I mean, we have no idea. So probably that if we probably try and bring them in for a meeting, then maybe that would be the question to ask them. Otherwise, no palm oil plant. Myself just buy a palm oil plantation stock because they're going to get hit anyway if prices come down, I guess. With the recent correction due to Russia, Ukraine, what stocks do you recommend to buy for long term? We still like the banks. I think the recent situation has only made inflationary pressures even more acute. And I think like Glenn mentioned, we still like OCBC. Of course, among the three banks, we all know DBS is the best. I mean, they've executed the best. But we're not buying the best operator. We're not buying the best bank in a way. We're buying the one that has the most upside in terms of earnings, in terms of dividends. I think that's what Glenn was mentioning. So the other things is that there's a lot of stocks that look very attractive. I mean, the small mid caps, there's a lot of cash, like we mentioned, Valuetronic, even Asonic, and so forth. Yeah. So these are some of the names, or even HR Net Group. We haven't done our note yet, but I think the results is also quite good. Okay. Russian market for the long term. What's the ETF? Actually, that's quite interesting one. Russian can maybe the opportunity. Yeah. The ETF. I do not know. I'm sorry. I don't really have the answer. Actually, I'm just googling it. Yeah. So my answer is as good as the Google. Yeah. I saw some of it, but I can't. Yeah. Maybe I'll share with you later. But I just I don't have the name here. It was just purely from googling, so not much value add on that. Yeah. So some of them is the Van Eck Russian ETF, or the code is RSX, and I guess the main one is the iShares MSCI. That's the ERUS. E Russian. That means E then RUS Russian. Sorry, I'm just googling the answer for you. Any good idea to buy good value stocks when Europe goes into recession? Any suggestion? Yeah, so sorry for Europe, we don't cover. Sorry, probably give you the wrong answer. Yeah, I'm not particularly clear which stocks. Yeah, sorry for that. For Elite, I think maybe, and the REIT one, maybe this who can. Okay, the next one, when is Wilmar Central Kitchen operating? I think they are building the building box right now, and it's already started operating, but I don't think it's hit the scale they want, because when you talk to Wilmar, their grandiose scheme. They spend 2 billion a year on capex. They're talking about the whole of China. So you probably see the incremental only this year, then maybe next year will be more meaningful. I mean, just to answer the question, they didn't really give when it will hit scale, but it could be 1 or 2 years, because Wilmar is talking about like whole of China and so forth. Yeah. So they didn't really give a precise timeline. Yeah, sorry for that. I miss your take on DBS and UOB. Glenn, maybe you can share. Any bank, okay, this one, so Glenn, is UMS earnings going to be positive? Is the results out? I'm not sure. So, yeah, I think Glenn, you can take on some of these. A lot of bank questions. The last one I'll take on before I hand over to you, Glenn. Hi Paul, when is the warrant detachment date for SPAC Nova Tellers? What should small investors do and their implications after the detachment? The detachment is for all the SPACs is 45 calendar days after the listing date. I didn't count, I didn't check, but it's generally the rule of 45 calendar days for any of the SPAC. What should small investors do? I think you can still keep it until they announce some event. Usually when they announce the de-SPAC, then there will be a bit more trading activity when it comes. But the SPAC is free for you, so I mean, just keep it. You can sell it whatever price you want. It's virtually free. Yeah, the warrants. I mean, sorry, the warrants are basically free for you. Okay, Glenn, hand it to you.
Okay, thanks, Paul. Yeah, so I think the first one I missed your take on DBS and UOB. So DBS I actually did it last week, not today. So anyway, I'll just do a quick run through. So why we like it, DBS, the positives is that the fee income grew. So it was 9% growth year on year. But however, quarter on quarter it fell, but because they mentioned that this was mainly due to the seasonally lower wealth management fee income. And their total allowances is 52 million. So this is much lower. Full year allowances were lower by 98% compared to 2020, sorry. Right. And then thirdly is that their loan growth also was up 9% in their fourth quarter year on year. And they have guided for mid to single digit or better for 2022. However, one of the negatives is that their net interest income and their NIMs have remained unchanged. So it's just flat for both. And but they also have guided for similar NIMs in 2022 of 1.45 to 1.5%. So DBS, why we like it is that because they have mentioned that a 1 basis points rise in the interest rates could raise their NII by about 18 to 20 million. So if we assume that there are 2 rate hikes totaling 100 basis points, our NII can climb by 2 billion or 21%, and this will result in an increase in our PATMI by 26%. And the second reason why also is that this is a benign provisioning cycle and they have guided accordingly. So they guided for credit costs of 12 basis points. And this is way below this is below the pre-pandemic levels in 2018 and 2019 of 19 and 20 basis points respectively. So this lower credit cost is mainly due to lower SPs as well as an improving environment. So for UOB, I just went through earlier, but I'll just briefly go through why we like it. So why we like it is that we expect that their PATMI should continue to grow. And this is on the back of their stabilizing margins, stronger fees, as well as lower provisions. And we also expect that their credit costs will continue to come in below their guidance of 20 to 25 basis points. There's also earnings upside from the write-backs of 1 billion in management overlay of their general provisions. For loan growth, they also have guided similar mid to high single digit for 2022. And this is comparative to their 10% loan growth for 2021. Okay, let me just click this. Any bank exposure to Russia? I believe there's quite a Russian community here in Singapore. And I think there's a second similar question. What are the bank's exposure to the Ukraine situation? So I don't think the banks are very exposed to Russia, but one of the main points recently would be the Russian, they are removed from the SWIFT transfers. So they can't do SWIFT. So I guess that's one of the main impacts of the Ukraine situation, where they can't transfer money freely. And of course, there'll be a lot more KYC and sort of things, the banks at the back end that they will have to deal with now because of all the sanctions that the US have put. So I guess back end, there'll be a lot more things that the banks are having to look at. Another question, how much do you attribute to the drawdown of banks today due to the MSCI rebalancing? And then also that the same thing happened in November 2021 and MSCI rebalancing. So that's a good question. I haven't looked in the details of the rebalancing, but I think you're right that the same thing happened in November when they rebalanced, and then because the banks were overweight, so they had to sort of release some of the bank stocks. But I'll look more into this and hopefully I can answer you better soon. So impact of removing Russia from SWIFT. So I think I just mentioned just now earlier, sorry, that the banking sector will definitely be impacted slightly by this because they can't do the transfers, but I'm not sure about what other sectors will benefit or suffer from this. Let me check, go through. Is iFast a buy now? I can't really comment on that because we don't cover the stock. Sorry. Okay, I think that's all for the banks. Let's take a look through again. Yeah, I think that's all for the banks. So I'll just hand it over back to my colleagues. Thanks.
Yeah, okay. The elite, yeah, sorry, the elite webinar, they cancel it. So the last minute they cancel. I'm not sure why, but they cancel it. So that's why we couldn't give an update of it. So I think there's another one from let me just say which China stocks. Yeah, sorry, we don't know about China stocks, so probably hard for us to comment. Which China stocks impacted by Russian geopolitics? Yeah, we can't. May I know where we could view the recording of the webinar? Is usually in our PhillipCapital YouTube, so we will try to upload it usually within the day. SPH REIT maybe okay. All these REITs on, I think I'll leave Natalie to. If the Ukraine crisis worsens and all supply is affected, how would the Singapore stocks be impacted? Okay, it would be indirectly. Yeah, I think it's a bit hard to, because this scenario will be just it just trigger the huge inflation and interest rate will just skyrocketed. Yeah, that's as much as we can say, because in general, most of the stocks will be like property and banks. I'm not sure how the Ukraine crisis impact, but it will be very, very indirect. It's more the impact to global growth. That will be the way it will impact Singapore stocks in general. I mean, the main one would be, of course, Food Empire. I think there's someone who asked, Food Empire's 50% of their sales and 50% of their profits come from Russia and Ukraine. They'll be doing an analyst briefing tomorrow. So we will try our best. We will definitely brief everyone what they said. I'm extremely interested to see how they're coping with the situation. So we will definitely brief everyone on Food Empire. On the Yang Zhejiang, so Yang Zhejiang I was in a meeting, but I had to leave because I had to join this. But the results did well mainly because of a lot of the investment gains that they had. This company is like we mentioned before, this company is like a shipbuilding with a hedge fund attached to it. So they got it's very hard to analyze because they got like maybe a couple $100 million gain on FX, couple $100 million loss on dividend income from investments, couple million decline in interest income for investment. So there's a lot of moving parts. So it's hard to get one, but the shipbuilding was down because lower margins. And also they got three parts: shipbuilding, ship rental, ship chartering. That one did well, and also the hedge fund, their so-called money lending business. Just the real truth of it. But anyway, in general, what we are just worried about the share price too for this one, because this is a shipbuilding company and it's all driven by order books. Nobody buy for the results. By the time the results is out, the whole shipbuilding cycle could be over, so nobody really cares about it. It's like a Keppel Corp. We're not going to look for the results. I mean, Sembcorp Marine, we're not looking for the results. We're looking for the order book building up or order wins. So we just worried that has already peaked. They've got a record order book of one couple of billion. Let's keep my mind. So we worried that could pick. They are going to spin off. The question is, they're going to spin off between the shipbuilding and the money lending. Money lending business. The money lending business is not only going to do in China. They're going to expand into fund management in Southeast Asia and everything. So they were dividend in specie. So if you're a young Zhejiang shareholder, you're also going to get this financial division, this finance division of it. Apart from that, really hard, unless we do some really hard, really in-depth analysis of it, we're not sure, but gut feel is that it could be a positive, because it could be a positive because the sum of parts should be higher, but again, we never do any analysis, so it's very hard for us to say how good it is. But usually when you do this kind of spin-offs, the sum of parts could be higher. That means although your Yang Zhejiang share price will drop, but the new entity could be higher than expected. But again, this is just a guess. Yeah, so I'm not sure if I was any help at all. Yeah, appreciate your comments on how I went to catch the bottom of this market. Yeah, it's all dependent on the news flow from Ukraine. It's very fluid. I have no idea how to catch the bottom. It could be probably a couple of weeks more before this whole thing resolves, until either they negotiate or Russia takes it over. That's probably the base case, and it could be a couple of weeks or months. Yeah, nobody knows. Sorry, it's beyond us. Really can't. But for us, we think the beneficiaries of the rising interest rates should be the banks. Besides HRNet and Velotronics, any good stocks to buy? I think probably those we'll wait for maybe Natalie's reports like on CLI and also CDL. Probably that should also still sit well. Yeah, because like what she mentioned, I think CDL is also going to do a REIT on the London, so there could be another catalyst. Okay, there's still a lot. I'm not sure how many we can try to answer. Let me answer this last one before I hand it over to you, Natalie. Please comment on the Thai BEV on the decision to IPO. I wouldn't be too excited about it. We did some estimates before. The impact to earnings per share would be, I think 3 to 4% only, because the benefit of it will be just to de-gear the balance sheet. And like we mentioned, 85% of the profit comes from spirits. I mean, beer division is, for now, it's more like a talking point. So this IPO would help reduce their interest expense and would probably lift their earnings per share. I think 3 to 4%. We did some estimates before, so it will create a lot of buzz, but the impact to Thai BEV won't be that much. But it will be good because it's going to de-gear, because to de-gear the balance sheet to reduce the debt. Nat, would you like to?
Hi. Okay, so for the Elite webinar, as Paul mentioned earlier, they actually cancelled on us, so we didn't even manage to hold the session at all. But thank you for all those people who actually signed up, and we apologize that it didn't materialize. Okay, so the next question is, with the rising interest rate affecting the share price of REITs, can you give your view on what are the key things to look out for, and which REITs are opportunities worth taking advantage of over the next 6 to 9 months? Okay, so yes, the interest rates are rising. 2022, 2023 expected to increase over these 2 years, especially. I think what we look for our REITs that have made acquisitions that will strengthen, not just acquisitions, but initiatives that will actually strengthen the portfolio and also provide some sort of growth. So those REITs that have acquired during 2020, 2021, for example, one of the REITs that we like is Escort. So for Escort, they have actually increased the proportion of their long stay assets. For example, your student accommodation as well as your rental housing assets, and that actually helps to provide. First of all, these assets, they benefit from domestic demand, so that means that they have high occupancies throughout the pandemic, and that also provides income visibility and helps to stabilize their portfolio, especially in view of the hospitality assets like your service residences and your hotels, where even during the pandemic, even though some of them were on master leases, the master leases could have been extended or altered such that it was now, instead of just being a master lease, it also has a variable component. So in a sense, their acquisitions into the long stay segment, they actually have to fortify the portfolio. So we look for these kind of acquisitions, these kind of transactions that will help to strengthen the portfolio. Yeah, so some of the REITs that are worth taking advantage of over the next 6 to 12 months. Yeah, we also do like some of the industrial REITs. I think that the share prices have actually come down significantly, and apart from taking a position in the recovery plays like your hospitality as well as your retail recovery, I think industrials will always be a good addition to your portfolio in terms of stability. So as the prices pull back, I think this actually presents a better entry for those who want to take a position in the industrial REITs. Yeah. Okay. So what is your take on SPH share REIT at this share price? So we don't actually cover SPH. And also for ARA Logo's presentation, I believe this is a TR only presentation. TR stands for Trading Rep. So because ARA as well as ESR, they are actually undergoing a merger, right? So it is considered a sensitive time for them, and usually their communications is to the general public is restricted. So they only can hold this kind of more limited audience kind of presentation. So unfortunately, it is not open up to the general public. So unless you're a TR, you won't be able to sign up for it. Yeah. Okay. Okay, another question. Does the high electricity prices have a huge impact on data center REITs? The answer would be not really, because for data center REITs, the electricity is actually on a pass-through basis. So whatever the price is, or whatever the price incurred, it will then be passed on to the tenant. Yeah. Whereas for some of the other REITs, the electricity prices they are expected to impact the REITs slightly. And for example, some of the industrial REITs, the management has commented that they will be impacted by this increase in electricity prices. So most of these leases, if they are on the gross rent kind of lease, net rent. Yeah. So basically, what happens is that they will try to manage the cost. And some of the leases, they actually do have the clause where they can increase service charges. So service charge is one way in which the manager of the REIT can try to charge a higher rate to compensate for the rising electricity costs. Yeah, and the REITs can also, of course, do some hedging. Yeah. Yeah. So for data center, the impact is not huge. Okay. Update on Tassin. So Tassin's results not out yet. They will be having a call on Wednesday. Yeah. So we'll probably be able to give more updates after Wednesday. Can you comment on target for Star Hill REIT? Is it a hold? Sorry, we actually do not have coverage on Star Hill at all. Yeah. Okay. Yeah, I think that's all for me.
Yeah. Okay. Let me just try to close it up. Is UMS earnings going to be positive? It should be any better because their biggest customer is Applied Materials, and their January quarter revenue was up about 21%. So they should report good numbers. Applied also guided second quarter, which is up to April. I think it's up about 12-13%. Yeah. And UMS largest customer is Applied. So the results should be positive in the upcoming results. There'll be a briefing, and again, we will try to brief everyone what did the management say. Impact on removing Russia from SWIFT, what sectors? A lot of it Russian doesn't really impact. I'm not sure whether it affects the private banks here, but it's mainly a lot of it for Russia. We just hope there is no retaliatory move by Putin. Yeah. Anyway, who knows? The next one is, can you brief commentary which large caps? I don't see any large caps. It's mainly Food Empire. That's the only one that we can think of. like we mentioned, 50% of the profits come from Russia and Ukraine. Any comments on the sharp rise on First Resources? Well, Wilmar, since I think Wilmar, First Resources is pure plantations. The plantations took the prices shot up recently also because Indonesia kind of imposed a condition whereby anyone who sells palm oil you need to sell a certain proportion of it. I think it's 20%. I can't recall. I think it's 20%. Don't hold me to the number, but they have to sell a proportion of it to the local, to the domestic users before they can export. So there was worry that the amount of exports that Indonesia can do in palm oil would kind of drop quite significantly. Whereas Wilmar will be, like we mentioned, will be impacted by the soybean crushing and also their consumer products. Because consumer products cannot pass on the higher cost increase, which is higher palm oil price. But just one reminder for Wilmar, I mean, the thing for Wilmar is in their palm oil refining, the margin is only 10%, but palm oil prices can move even $100 in a week. So a lot of it, they always remind everyone, is the ability to timely purchase the forward contracts. So it depends on how well they read the market prices. So that could also affect their margins and profit. I mean, just a disclaimer to that. Hopefully we're not looking at stagflation instead of inflation. Yeah, absolutely right. But so far right now, I mean, the global growth doesn't seem to be impacted. So although we have inflation, but global growth is still growing. So hopefully that persists. Yeah, unless you like you mentioned, unless Europe goes into some recession tailspin. Okay, I think that's it. I think we have to end it. Thanks everyone so much for your questions. I think there's almost 50 questions. Thanks so much, even though there was no technical ones. Again, we're still trying to get a technical analyst up and running so that you can help any technical questions. With that, I'd like to thank everyone for your time, and we will definitely brief everyone of some of the meetings that we kind of everyone was asking. So like Tasin and so on. So we'll brief everyone on what happens in the meeting. With that, I'd like to thank everyone for your time and especially all your questions. Take care and have a good week ahead, everyone. Bye-bye.